Hello there, corporate employees, and welcome. Thank you so much for joining us today. I'm Sam, and I will be moderating this presentation behind the scenes here. If you have any questions throughout, please feel free to enter them in the Q&A box. It's completely anonymous, and I will make sure they get fielded to one of our financial advisors. Today, we're going to be joined by Michael Corgett, one of our financial advisors here, who's going to be speaking to you on whether or not it's the best choice for you to take the lump sum or the annuity option when you decide to retire from your company. Afterward, I apologize in advance. He will not have time today to answer any of your questions live, but as I mentioned, please feel free to enter them and I'll make sure someone reaches out to you after the presentation to answer them. Lastly, I would like to just very quickly remind you that we are not with your company. We are not affiliated nor endorsed whatsoever by any of your specific companies. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along today. And very quickly, I want to just make you aware, you will see some links popping up on your screen as you watch this presentation. Those will be from me as well, and they're going to guide you to different resources we have, such as our calendar, where you can book an appointment with one of our financial advisors to speak to them directly. It is a free 15-minute block of time you can use to bring up any concerns, answer any questions, or get started or updated on your retirement planning, and we'd love to help you with that. You can also follow us on YouTube and LinkedIn. We post tons of retirement-focused content each week, and we really think you'd get some value out of it if you considered giving us a follow. And if you do, thank you so much in advance. And without further ado, we're going to jump right into it now with Michael Corgett.
Thank you, everyone, and thank you, Sam, for the introduction. Again, my name is Michael Corgett. I'm an advisor here with the firm. Today, we're going to talk about pension distribution options, essentially the difference between a monthly pension or what's called an annuity versus the consideration to taking a lump sum if you have that option available to you from your employer. So let's go ahead and dive right in. We're going to talk about the single life annuity and then various joint and survivor options, as well as various lump sum options, and then the look back period when we talk about interest rates. And interest rates have a major impact on many lump sum calculations. The single life annuity, this is the monthly amount. This is the largest amount because it is based on your life, your own life expectancy, no one else's. This is the amount that all other options are based upon. So essentially, all joint and survivor options, period certain options, every other option is going to be based upon this dollar amount. There are going to be fractions thereof of this particular dollar amount, as well as the lump sum. So it pays you a monthly fixed amount. For example, $3,000 a month. You're going to get that for the rest of your life. Typically, there are no cost of living options built into any private employer pension program. Some public employer plans do have cost of living built into them, and obviously Social Security, which is also a monthly annuity that you get, but it does adjust for cost of living each and every year. So for the sake of our presentation today, single life annuity, the maximum monthly amount that you would receive based on however you earned it, based on the formula that your employer had for you to earn your various pensions, is the maximum monthly amount that you're going to earn. Joint and survivor options are just that. If you're married or have a spouse that you want to take care of, you can get various joint and survivor annuity options. You will typically take a reduction in your monthly amount to provide your spouse or significant other with a monthly amount in the event of your death. For example, let's just say again, $1,000 monthly pension, and you have a joint and 50% survivor or a 75% survivor or 100% survivor option. Again, the more you want to provide them, the less you're going to get. And for example purposes, a joint and 50% survivor might reduce your pension benefit by 10% or $900 a month on a $1,000 a month single life annuity. A joint and 75% will reduce it even more. Let's say 15% reduction. So now you're down to $850 a month to provide a 75% of that amount to your spouse or significant other. And then finally, a joint 100% survivor could reduce your benefit by up to 20%. So you're going to provide your spouse with a larger monthly amount, but you're going to take a haircut during your lifetime. You got to keep that in mind. What's important? We all want to take care of our spouses. You can self-insure a spousal benefit if you are insurable. We call this pension maximization, and it might be something that you might want to consider, and we'd love to talk to you more about it. There are period certain options with many employer plans. If you're single or your spouse is gone or you've never been married, you can get a single life annuity and then take a small haircut to get a 10, 15, or a 20-year period certain paid out to your beneficiaries, like potentially your children or other relatives, whatever they might be. So many employers offer those types of options as well. It's you just got to keep in mind that survivor options are definitely important. Oh, by the way, most pension plans also offer what's called a pop-up provision. If you took a survivor benefit and you took a reduction in your single life annuity and your spouse or partner predeceases you, you typically will pop up to that single life annuity amount. Lump sum options. Again, many employers offer lump sum options. It's the actuarial equivalent of the single life annuity. It's going to be based on your life expectancy, typically first and foremost. If you're 55 versus 65, you obviously have more life expectancy at 55 than you will at 65. And all else being equal, your lump sum will be more, especially if you worked side by side with a colleague and they were 65 and you were 55 and everything else was equal. Your lump sum will typically be larger because you're going to live longer. Also going into that calculation typically is going to be a interest rate factor. Essentially, a lump sum is a big barrel of money. In that barrel, your employer puts a hypothetical amount of money in that barrel, and that's what determines the single life annuity and all your other pension options. The interest rates are what's credited on that barrel. Essentially, on a lump sum payout, the same interest rates have an impact. The higher the interest rates, the less money your employer has to be put in that barrel, which means your lump sum will be smaller. Vice versa, the lower the interest rates, more money needs to go into that barrel. That means your lump sum will be larger. Lump sum payouts are paid to you. You typically want to roll those over into an IRA so they remain tax deferred, and then create your own income stream from that lump sum option. There is a death benefit available to your spouse and or family if the money is invested properly and you don't overdo the withdrawals on it. But there is no death benefit on a lump sum option if it's left with your employer. That is typically the joint and survivor or the single life annuity options. Think of the interest rates impact on your annuity as a mortgage, okay? You could typically borrow more if the interest rates are lowered. As you could see in this example, the monthly payment's $1,950. If you get a 3% interest rate, you can borrow more versus a 4% interest rate, as illustrated here. So you're going to want interest rates to be lower if you're going to choose the lump sum option. And that's where this look back period comes in. Most employers will look at interest rates, and I'm going to go over the segmented interest rates here momentarily, but they're going to look back historically at interest rates, and they're going to pick a period in time. Let's just say 1 month where the interest rates, and those are the interest rates that they're going to lock lock those rates in for calculations for the entire next year of lump sum calculations. And if interest rates are trending higher, that's not a good thing. If they are trending lower, that is a good thing. And here's an example of the IRS's segmented interest rates, which many employers do use. As you can see here, they're published monthly, and you can find these on the IRS's website. Interest rates in the last few months have trended downward from January to February to March, which is a good thing. Now, for some employers, it's too early to look at those interest rates for a calculation for next year. But for some employers, they look at these rates and they will lock them in quarterly. So it just depends on your own employer program. But keeping in mind, interest rates are very important, thinking of it as a teeter-totter. The lower the interest rates, the higher the lump sum, and vice versa. I've said a little bit and I've also said a lot. The most important thing, I believe, is that hopefully you understand the difference between annuities and lump sums, but more importantly, put a plan together. Have an idea of where you stand right now. Take advantage of a complimentary service that we're happy to offer you, and let us put a written plan together, because most Americans don't have one. And the sooner that you put a plan together, the better off you're going to be longer term. And I can't recommend that enough. We are happy to put together a complimentary retirement cash flow analysis, and it's a complimentary service that we have to offer. Why would you want to consider us here at the Retirement Group? Well, we've got a lot of experience. We have got a lot of experience working with your employer. We've got a very great background on your pension, your 401k, and your healthcare benefits. So we know what we're talking about. And again, that complimentary cash flow. You could schedule a meeting by scanning the QR code here on the left with myself or one of my colleagues. You can follow us on our LinkedIn page by scanning the code here on the right. I strongly recommend you do. We've got a great LinkedIn page. And on that LinkedIn page, amongst other things, is our future webinar schedules. Send us an email or give us a call. We look forward to the opportunity to speak with you. Again, we do know a lot about most employers' plans, and we do understand how these pensions work. So give us an opportunity, reach out, give us a call, send us an email. We'd look forward to talking to you soon. Thank you.